Hey, good morning, everybody, or good afternoon, whatever time you're watching this. Welcome back to Warner Realty Group Talks with Experts. I'm Sandy Warner. If you are not yet subscribed to our channel, go ahead and hit that subscribe button and hit the bell so you get notified anytime we bring a new and interesting expert in real estate to you. Today, we're going to talk about something that I have talked with lots of my clients about. We're going to talk about what's called a Delaware Statutory Trust. And this is really going to relate mostly to our investor clients. And this is Ron Cole that you can see on screen with me. And Ron owns a company called Cole 1031 Solutions. And he's going to explain this alternative to a 1031 exchange in real estate. So please join me in welcoming Ron Cole. Thanks for joining us today.
Yeah, good morning, Sandy, and thanks very much for having me. It's a pleasure joining you today, and anybody watching, hopefully this will give you some ideas on maybe some alternatives if you're considering a 1031 tax-deferred exchange. I founded my company probably 4 or 5 years ago, specifically dedicated to working with individuals. So I've been in the financial services industry for 30 years, but am now exclusively dedicated to working with individuals that own investment real estate, providing them with a solution, hence the name of my company, Cole 1031 Solutions, for anybody who is looking to potentially sell an investment property, but maybe there's times when they don't want to go out and look for a property and own and manage a property on their own. I have a solution or a few different solutions that can provide an option for folks that are in that situation, and happy to answer questions as we go along.
Fantastic. So let's talk real briefly. I think everyone who kind of is around the real estate world has at least heard the term 1031 exchange. And a Section 1031 exchange just means that if you're going to take one investment property and you sell it, and you all know we get, when we sell investment properties, there's what's called capital gains, which is the amount that you earned over what it cost you to buy that property, and you get taxed on that amount that you gained. That's why it's called gains. And those taxes can be somewhat prohibitive. But if you're selling one investment property to buy another one, you can push those taxes off. And with some smart tax planning, you know, it could result through inheritance that those taxes are never due. So Ron, why don't you talk, let's talk specifics. What is, I was thinking you only had a Delaware Statutory Trust. Why don't you take that from there? Are there other options?
And just to add to that, Sandy, and it's a great point, obviously someone selling an investment property that maybe they inherited or they've owned for many, many years, there's not only, and disclaimer, I don't give tax advice,
Me either.
But there's additional taxes that would potentially be due as well. So in addition to the capital gains, there's depreciation recapture. So many times folks have depreciated the property over the years. That's fully 25% of what you have depreciated on top of your capital gains. There's the net investment income tax of 3.8% added to it. And then of course, any state taxes. So sort of back of the envelope, it adds up quickly. And, someone selling an investment property could conceivably owe in the neighborhood, of 35 to 40% in taxes overall. So the 1031 tax deferred exchange is a tool, really, and I refer to it sometimes as a gift from the IRS. As we know, they don't provide many, but in this particular case, the criteria is that it's not for your primary residence, but loosely, the criteria for a successful 1031 tax deferred exchange is really selling investment property and buying or reinvesting the proceeds into investment property. So someone selling a two-family in Newport, I don't want them to feel that they're beholden to go out and buy, a multifamily or residential. So it's pretty loosely, guided in terms of what you can invest in as a replacement property. So what I utilize is, as you mentioned, Sandy, a Delaware Statutory Trust, otherwise known as a DST. That is the primary vehicle that I use. And in short, what it is a passive fractional ownership in institutional quality real estate, which brings you a lot of the benefits of owning real estate, including the ability to depreciate if there's a mortgage on it, to benefit from the interest expense deduction. You derive a monthly income, so you're replacing any income that you may have been receiving from your relinquished property, but you don't have any day-to-day management responsibilities of tenants, toilets, and trash, as they say, the 3 T's, allowing folks to have most or all of the benefits, but without a lot of the headaches associated. And there's a number of other benefits, which includes if someone's selling an investment property where they had a mortgage, really the criteria is that you need to replace the debt unless you're willing to come up with additional equity. And I could certainly go into more detail on that. But one of the benefits to a DST is that you are allocated debt that's already put in place on the property or properties, because many times DSTs are structured with multiple properties, but the debt is non-recourse to the individual investor. So a lot of times I work with folks that, quite frankly, they're retired. The last thing they want to do is walk into a bank and take out a loan for a property that they're buying to replace their relinquished property.
Right.
So it's really, I think, advantageous from that perspective.
So if you're an investor, we work mostly in Rhode Island, southeastern Massachusetts, but really anywhere. So say you're an investor and I have common stories here that, local families have accumulated 2, 3, 4, 5 multifamilies, and now they've gone to Florida, or they've gone to Colorado, and they really don't want to manage these properties. They don't want to pay someone to manage these properties, but the tax implications are so prohibitive that they're kind of stuck in them. So
Right.
If you wanted to sell your property, but you're worried about the tax, you could talk as an alternative. One alternative is to have someone else manage it, or sell it, and instead of purchasing a physical property, you would participate in this investment vehicle, which is sort of more like buying a stock or a bond or in that sort of idea.
Yes, although and absolutely correct, and you hit it right on the head in terms of what this allows folks to do in terms of their real estate planning. Again, many folks are hesitant to put their real estate on the market, knowing that the tax implications could be substantial unless they go out and buy another property.
Right.
But again, many folks don't want to go out and buy another property that, number one, in this current environment that we're in, trying to find the appropriate property, doing your own due diligence potentially, going and putting financing in place if that's a necessary part of your overall exchange. And quite frankly, just being up against a lot of potential other buyers. And I run into a lot of folks that have fully intended to go out and buy a property where all of a sudden, there are some, I say in 1031 world, there's some things that are gray, and then there's things that are very specifically black and white. The gray is, again, the type of property that you need to utilize to replace your relinquished property. And again, that's very loose in the sense that you can go from multifamily to a warehouse distribution or vice versa. But what's black and white is you have a 45-day identification deadline. So if you sold today, you have 45 days to identify replacement properties. And there's a few methods to identify, which I won't go into too much detail, today, but there's the 3 property rule, there's the 200% rule, and the 95% rule. Most widely used is the 3 property rule. But again, you have that finite period of time, and right. 45 days, as you know, goes very quickly. So the DST is a nice alternative. And if I just hold up, this is a DST property menu that's multiple pages. I won't flip through all the pages currently. This is updated roughly weekly. There's anywhere from 20 to 25 different options at any given time, which include various property types, multifamily,
right, hold on.
Warehouse distribution, healthcare assets, self-storage, and others. And so it allows someone additionally, Sandy, where if someone, I'll use $1 million example, with the DSTs where the minimum investment is 100,000, it allows someone to structure, which I do on a regular basis, a portfolio, if you will, of various properties around the country. So you get geographic diversification, property type diversification, as opposed to $1 million, conceivably you're going to go out and buy one
building. Yeah.
And, the DST allows you to structure a diversified portfolio of various property types around the country, if that's what you're interested in.
And thus, you're minimizing your risk. If you're diversifying out into multiple properties, say you've got, 600 you need to move. What Ron is saying there in layman's terms that I can understand, in case agents are watching, maybe don't have a background in finance, is that rather than purchasing one building, which say that building burns down, or say there's zoning changes and you can't do what you were doing, or God knows, whatever. I say Massachusetts invades Rhode Island, who knows, right? Anything could happen. By diversifying that risk, instead of having all of your ducks in one basket, you might have, and you probably won't, that's still a low risk, but you're minimizing that risk even further. So you're decreasing your staying awake at night, hoping a tenant doesn't call you. You're decreasing your anxiety over selling yours and trying to find the next property in the right amount of time in a market where inventory is at a minimum, and you are you're able to sort of move that tax burden down the road, which is really your goal. It doesn't go away. It just means you don't have to pay it all right now. And when you own these properties as families, you can kind of work with your estate tax person, and I bet, or your estate planner. And sometimes you really can defer until, not to be grim, but you've passed, and then we get step-up bases, and it's just it's something to consider. What does it look like when, so I have a multifamily, I'm standing in a multifamily, and I decide to sell it, and I want to go into a DST. What steps happen?
Yeah, so and I'm really glad you brought that up. When I mentioned black and white, one of the very specific criteria for I always say successful 1031 exchange, is that you need to utilize what's known as a qualified intermediary, otherwise known as a QI. And this is a person or entity that when you go into the closing of your relinquished property, the one you're selling, you never want to take constructive receipt of the proceeds of that sale.
Yeah.
That will immediately disallow your 1031 exchange. Yeah. I have had folks call me and say, Ron, good news. I sold my property and the money's sitting in my checking account. What can we do? And I say, nothing other than pay your tax and maybe go on vacation. But very important. And of course, as you can imagine, I work with a number of qualified intermediaries. So if someone, whether they called me to, work with a DST or not, I'm happy to share, names of qualified intermediaries. But again, very important, a mandatory part of it. So upon the sale of the property, the money, the proceeds goes directly into an escrow account held at the qualified intermediary.
Mm-hmm.
At that point, again, whether you're going out and buying your own property or working through me, looking at the Delaware Statutory Trust option, we would then identify whether it's by property type or what your individual criteria is. I have many folks that say, I don't like retail, or I've been in multifamily, but I'd like some other type of asset class or property type. So we can look at the options available and identify using one of the three identification rules. As I said, the most widely used is the three property rule. And quite frankly, once you've decided to do that and move forward, it's quite simple. There is some documentation, as you can imagine, much like if you went into a brokerage firm, a Merrill Lynch, I'll use that as an example, and you said, I wanted to open an account, they would have you fill out a new account document. I have an equivalent to that. And then the sponsor of the DST has a couple of documents. I have an assistant that works with my clients, very seamless, using DocuSign typically. And it's a fairly painless process. The money then, once you give your final approval, the money is then wired from your qualified intermediary escrow account to fund the investment. And very shortly thereafter, depending on what time of the month you close, you'd be receiving your first monthly distribution, conceivably in several weeks.
Wow.
And you do receive a monthly distribution each and every month. And you don't have the day-to-day management responsibilities. But you brought up something about sleeping well at night, I think. I have an acronym I use. It's called SWAN income, which is exactly that. Sleep well at night.
Yeah.
So that's,
as professional property managers, we never sleep because you always
Right.
think that phone's gonna ring.
well, and that's, I think, one of the nice things about, the structure that I use is that you're not getting that call. It doesn't mean that things aren't happening behind the scenes, but one of the things I always point out, when you invest in a Delaware Statutory Trust, you're in essence hiring a team of people on your behalf. Number one, they've done all the due diligence, all the legal work, put the loan in place if there's a mortgage, property management, as well as a tax statement, which then you can bring to your accountant, and it breaks down the depreciation, the interest expense if there's a mortgage, other property level expenses that you can then use to shelter some of the income. And again, I don't get too involved in the tax advice part of it, but you do benefit. It's a pass-through entity. And so you benefit from the depreciation and other property level expenses to help shelter some of the income tax that otherwise you would pay.
Ron, I'm going to post your phone number up here, but why don't you tell people if they want to get in touch with you, what is your phone number? Where's your office? How do we get in touch with you?
Right. Yeah, I appreciate that. My phone number is 646, area code 646-477-6338. It's the only phone I have. It's always with me, and I'm always happy to field questions, quite frankly, and discuss this in more detail with folks. My email address is ronald@cole1031solutions, plural.com. And that's Cole, C-O-L-E, 1031solutions.com.
Ron, thank you so much. I heard you speak years ago and I've always had you in mind. I'm Sandy Warner with Warner Realty Group. If you haven't subscribed yet, go ahead and hit that subscribe button. Give us a thumbs up if you thought this content was good, and ring the bell so you know the next time we bring you an outstanding local professional to help you with your real estate investing goals. I'm Sandy Warner, making the complex simple.